Happy New Year from Camelota Advisors. I wanted to make this video to give you an idea of what happened in the economy, how it affected markets, and what I'm considering for 2023. Last year marked the beginning of an economic transition that was defined by a decade of 0% interest rates, first to support the economy in the wake of the global financial crisis in 2010, and subsequently in 2020 to support locked down economies in the face of COVID. Accompanying this transition is a transition in markets. We saw a bear market, which could be seen as a transition point from old market leaders to new ones. The old market leaders performed well in 0% interest rate environments, these being risky assets, growth stocks, non-profitable companies, technology, SPACs, Bitcoin, things like that. With higher interest rates, there are and higher inflation, there are organizations that are able to capture the benefits of that better than some of these less profitable companies. Think consumer staples, think industrials, financials, even the commodities complex could benefit from higher inflation and interest rates. So I think those are probably the places to look for new market leaders. No crystal ball, but I'm thinking that's going to be where things go. I don't think that this is going to be a permanent, or I don't think this is going to be a temporary transition, but I think it will be permanent, which gets me into the next three themes to look at for 2023. First of all, China's reemergence on the global stage is going to be an important factor. They've been locked down for a very long time. Their consumers are eager to consume, but at the same time, you're seeing a massive COVID outbreak that could lead them to have fewer people showing up for work. So you'll have lots of demand combined with suppressed supply, which could be more inflationary. Secondly, I think that the Fed's ability and credibility to fight inflation is going to come into focus. The Fed is keeping interest rates higher, or taking their thumb off the scale, I should say, and letting interest rates rise in the hopes that it will squelch inflation. There's a narrative out there that says that there could be a recession that would cause them to lower rates. We're not seeing the data showing, certainly no bubble bursting like in 2010, and definitely a mild recession that would not cause the Fed to need to respond. Thirdly, I think that we're going to have to consider the fact that maybe the things going back to normal will look a lot like they look now, with inflation staying high for a while and interest rates staying higher, which means that we want to look at other types of investments, even investments outside of the US, which could benefit from both a weakening dollar and resumed capital flows into both emerging markets and developed economies. I hope this gives you an idea of what I think about what happened and where we're going with things. I'm always available to discuss in more detail, and I wish you a happy 2023. Thank you.